Hi, my name is Mike Mills, and I'm the managing partner here at the Legacy Advisor Group. Today is Wednesday, April 30th. A lot has transpired since our last recording, just shy of a month ago. The market dropped rapidly after Liberation Day on April 2nd and proceeded to sell off more over the coming week with some very volatile days. However, on April 9th, we saw one of the largest one-day rallies in the market ever. Since then, the market has traded fairly sideways, getting back about half of the decline so far this year. The S&P 500 is still off about 500 points from its February high. The yield on the 10-year Treasury spiked to nearly 4.5% and is now back down to near 4.2, and still off its beginning of the year high of 4.8. Additionally, consumer confidence numbers are at a 13-year low according to the Consumer Confidence Index, and overall sentiment is down. Remember that quote about maximum point of pessimism from our last video? I share this because it's easy to get whipsawed into making erratic decisions as it comes to investing and day-to-day money decisions. We've said in the past and remind you that this is short-term volatility. There's value in staying the course. This chart from our friends at First Trust shows the value in staying invested with a $10,000 investment in the S&P 500 and then the cost of missing the best days in the market. Now there could be more volatility ahead. We could test the low of 4,900 on the S&P 500 put in earlier in April. Or the bottom could be in and we do not retest. The point is, there will not be a bell rung stating the bottom is in or volatility is over. This is why we must stay focused on the long term for investing, for you and your family's goals. We could possibly enter higher inflation and lower growth, referred to as stagflation, or things could improve greatly. There is no shortage of speculation on either outcome. There are plenty of folks out there that will share their forecasts. Most will be wrong. There's also speculation regarding a possible recession, decreasing the value of the dollar and supply of goods on shelves in the coming months. I will not add to that speculation here, but we are keeping an eye on both very closely. As a quick add, just before recording this video, Q1 GDP just came in slightly negative. So we're keeping a very close eye on growth and how it correlates to companies releasing their earnings and their guidance. Most are withholding their future guidance. Now, I was told long ago that there are only two things you can really control, and that is our attitude and our activity. Our attitude here at the Legacy Advisor Group is to stay focused on the long term and you and your family's goals. Our activity, well, that varies depending on your goals and your risk tolerance. For our more risk-averse clients, we've sold some of the riskier assets into rallies and repositioned during market dips into other asset classes. For our more risk-tolerant clients, we've added to positions during the dips. We've also maintained cash and cash alternative buffers. We often refer to these as a war chest. This has allowed us to deploy some of these assets during market dips. One other opportunity presented in the last month with all the volatility is the ability to be able to bank some capital losses to offset capital gains that some clients may have coming up. Lastly, our allocation to international markets I referred to earlier this year has been a nice additive to positive performance so far this year. There have been a number of reports stating that assets are shifting on the institutional and endowment front from U.S. to international equities. We do not doubt this, but remember the U.S. has been an overweight for most over the past 5 to 7 years, and rebalancing is prudent. Diversification still matters. So with that, we'll wrap up this Market Minute. As always, if you have questions or concerns, please reach out to any of us here at the Legacy Advisor Group. And on behalf of our team, thank you for your trust, and have a great day.